Today's podcast is special. It's a business playbook on acquisitions. $5 million is what people who want to start a business in the US have access to. On today's podcast, I had the pleasure of welcoming on Mark Fleming, the CEO of Owner Actions. They are an M&A advisory firm, and they actually take equity in businesses that they partner with. Honestly, I was blown away by some of the concepts, schools of thoughts, and just insight that Mark was able to share. Follow this man, follow their company on TikTok, because what they go through, if you're into business, it's Business 101. Enjoy. As entrepreneurs, we all experience challenges in our business journey. I'm Jay Story, and the Grappling Growth Podcast is my attempt at documenting my entrepreneurial journey while building my brands. I sit down with fellow entrepreneurs, understanding how they grapple with growth. I hope you find value and enjoy. Pleasure to have you on the podcast.
Yeah, thanks for having me. Happy to be here.
Mark, I'm curious, what does growth look like to you?
Yeah, so we have, two different ways we're going to look at growth. So we have, growth for our own company and growth for our portfolio of companies that we own and that we work with. And so for our own company, our goal is just to, create more successful business owners. So as long as we're creating more successful business owners, we're really happy. We're less focused on the pure financial metrics and more on making more successful business owners. So, say building better buyers, building better businesses. In our portfolios of companies that we work with, it's more about reaching their goal. So each person has a different goal. And, so it doesn't matter if my goal is to grow something to $100 million company, and really that's not where they want to be, then, us working towards building a $100 million company isn't going to be the right growth. So it's really figuring out where they want to be in the next 5 years and then getting them to that point. Because within our companies, not everyone wants that huge company. They want something that, also fits their life and works for them.
Mm-hmm. And just for the sake of the listeners, can you just decipher and just explain what you guys do at Own Actions?
So at our core, we're an M&A advisory service. We primarily focus on helping individuals buy small businesses. And we do everything from helping find the business, evaluate the business, getting it financed, coordinating legal, everything to do the acquisition. And then for that, we take ownership in the newly acquired business. And because we're partial owners in the business, we want to see it be successful and we want to see it grow. So then we stay on, we help our business owners. We do things like financial management. We pay the bills, we collect the receivables. When customers aren't paying, we pick up the phone and we call them. We handle all those things along with marketing. We'll do some marketing because we want our partners to be focused on what we say is customers and employees. So the more focused they are on helping their customers and helping their employees, the better the business will do. So, post acquisition, we stay on as an advisor, help every way we can.
So you must have gone through a mill of successful, not so successful businesses. Are there any key characteristics from a bird's eye view of what you find that you see as commonalities and characteristics amongst the successful businesses that you've partnered with and taken over?
So for us, a lot of the success comes from on the acquisition right up front is, buying the right type of business is going to have a big factor. So we want to make sure that we're buying businesses that fit our partners' skills. So, we've got restaurants that are doing great. A lot of other people hate restaurants. Some of our best businesses are restaurants. We've got HVAC companies. Everyone loves HVAC companies. Our HVAC company is doing great. If I take my restaurant guy and put him in the HVAC business, he's going to fail miserably. And if I take my HVAC guy and put him in the restaurant business, he's probably going to fail miserably. Right off the bat, it's really making sure that we get that good fit. In our space, there's a lot of people that make content about buying businesses, and they kind of give this myth that anyone can just buy anything and be successful. And that's not true. You've really got to buy something that fits your skills and what you're good at. So, For us, that's number one, making sure that it's a good fit for that person. And then once it's a good fit for that person, it really comes down to formalizing processes. So most of these businesses are really disorganized. A lot of them still run on pencil and paper. And so bringing that in and putting in systems in place, whether it's a CRM or a point of sale, putting in systems in place and starting to follow it. And once we get those in place, then again, it frees up our partners' time for, again, customers and employees. So they're doing less, administrative work and dealing with fewer headaches, and then the business is going to grow better.
It's interesting you say that, because what you're talking about, and I haven't jumped on any of the rungs with regards to acquiring a business. I just run my own business. But these are conversations that I have with friends, as I mentioned. And I'm curious, the way how we materialized it is you've got monkeys on your back and you're just trying to take these off so you can run faster. And it sounds as though you're saying to really run fast, you need to focus on customers, acquisition, client success, making sure your customers have the best experience possible, and then making sure your team is happy, they're being efficient and effective. Why have you guys deciphered and got to the point where it's all about customers and employees for the owner operator?
Because I think if you start with your employees, so if your employees are genuinely happy and they're glad to be there at work that day, they're going to perform better for your customers. If you have a good process, they're going to be your employees are going to be happier and, again, do better for your customers. I always say, within our owner actions business, some people come in maybe into our system in an unusual way. It's not the way we receive our usual customer. And anytime someone comes in and we're not following our normal cadence, we screw something up. And then if you screw something up, that's bad for everyone. Like, we're going to feel bad. The customer is going to have a bad experience. And they might tell someone they had a bad experience, which that would be the worst. Of course, it would just be bad if they had a bad experience and never say anything. And then, they don't recommend you to anyone. So if you build a good system that takes care of your employees, they know what needs to be done, how to do it, and they just can consistently follow that process, that will then create a good customer journey. And then if you have great experiences for your customers, they're going to tell other people, which customer acquisition is really expensive. So if you can get your current customers to tell other people about your business, whether it's our M&A business, whether it's our outdoor kitchen business, whether it's our HVAC business, the cheapest way to acquire a customer is to have a current customer tell a friend that you did a really good job for them. So if you do that, it's the cheapest growth you can find. I'd much rather do that than pay the Google tax on Google AdWords.
But just playing devil's advocate here, as someone who helps businesses with customer acquisition, looking at referrals and having a friend tell a friend isn't reliable. It's hard to predict it. Seasons, you might get 5 referrals in 1 month and then none for the next 3 months. So I imagine that we all have referrals, and typically you're going to be closing at 89% conversion rates. But for you guys, what channels have you seen to work well to grow? I know that you guys do a lot of content, as you were telling me a few weeks ago, and that's one facet. But Google, Meta, are these plays that you use, or what does that look like?
Exactly. Yeah. You can't count on referrals. You want to get as many referrals, and the best job you do, you're going to get more referrals, but you need other channels. And I think like, you hate to say quote like a Gary Vee thing, but Gary Vee will always say, like, should I do this or this? And he's like, the answer is and, right? You should do both. So it really depends on the business, what type of marketing channels we're really leaning on. So for the owner action side on the M&A business, TikTok is by far our best path to meet new customers. And really the reason for that is, it gives us a good chance for our customers to really get to know us before they ever come to us. Our content is, it's not exciting. It's just me in front of a screen talking. But by the time that I'm actually meeting with someone for the first time, it's almost like we've had a dozen conversations. So they know who we are, they know what we're about. And those are by far our most successful customers. They are people that know that buying a business isn't just a get rich quick scheme. You can become very wealthy, but you've got to work really hard to get there. Versus people that do come through referrals, they haven't been trained as well, and maybe they've seen content from other people that make it sound like it is just an easy get rich quick scheme. And those people with that view, sometimes we can deprogram someone and get them ready that you only want to do this if you're really ready to go through battle. If you're not ready to go through it, like, business ownership probably isn't for you. But it's a long process of like retraining people versus if someone comes from TikTok. And TikTok's a great channel for that business, because it's a discovery channel, so it's getting pushed out to people. They don't have to come to us, and you get more time to talk. Versus like Instagram. They've a few months ago they increased their time, but in 60 to 90 seconds, like, you're only going to get out a scam. Like, you can give someone something that's too good to be true in that time, but like, you can't give anything that's nuanced. So I mean, that's why TikTok's been great for us and kind of our preferred venue for that side.
When you started to push out on TikTok, because I think that will catch a lot of people by surprise, were you caught by a surprise initially when you started to see the traction and success?
Very much. So I mean, we started on TikTok. Originally our platform was more of a digital platform. We'd say, we spent 2 years building something that would walk business owners through step by step. We'd say start, scale, sell, and everything they would need to do. And it was really detailed. So for something like a restaurant, so we had some industry specific channels. Right, there's 185 things you need to do to open your restaurant. And we had all 185 with everything you needed to do, vendors, everything to help you along the way. And really, it just overwhelmed people. When someone saw that 185 things, they just didn't start a restaurant. And so that had essentially not worked. So we just started making TikTok videos and like, well, let's just go build an audience and we'll kind of pivot and we'll figure it out from there. And my background is investment management. I've done some private equity. Breaking down businesses was pretty easy for me to do. I've done that PE at hedge funds, what you might present to an investment committee, and did that for small businesses for sale. And that just took off. And that's where we had folks decided, well, our favorite way to get into business is through acquisition. That's how we were doing it ourselves, as opposed to starting a business, as that we were acquiring. And people asked for it and it just launched. And then we created the business effectively around the client demand.
So would you literally, just to dumb it down, would you go on the internet, find a business that's for sale, find their financials, commercials, and then dissect whether it's a good deal or not, or look at what you would be looking at there?
Yeah, we would. So we'd have to stick to the public info because you normally have to sign a non-disclosure.
Of course.
But yeah, we would go with what was publicly available, and really break down the industry, break down the risks, actually go through the numbers. And there were some other people that were doing, and we didn't know it at the time, but other people were doing similar kind of business listings. But there were people that were more media personalities than, say, investment professionals. And so when they'd see something that's listed on a website that says it makes $1 million a year net profit, they'd tell people, oh, you're going to take home $1 million. It's like, well, no, you're not, because, you're going to have a $500,000 loan payment. You have to make investments in the business on, capital expenses. You're going to have taxes, so we would break down like the real numbers of what you'd actually take home. That $1 million turns into about 250, 300 real quick. And that's really what you take home in a business that says you're going to make $1 million on a website, which still isn't bad. So there's nothing to sneeze at. But not what other people were saying. So that's kind of where we stood out, was giving real numbers and real industry breakdown of what the risks were. And again, everyone else was just kind of like, oh, here, you can make $1 million a year. It's going to be easy. Hire a manager. So we had a little more realistic insight.
That's one of my favorite people who I follow in the acquisition space. You've got guys like Alex Hormozy, but Cody Sanchez, I think she does a pretty good job, and she's done a very good job at educating Main Street as to how you can go about navigating these deals. But I haven't studied too much of her content, so I can't comment heavily. I imagine a lot of it is a tip of the iceberg as to what you're talking about. It's looking at a few formulas and processes as to how she looks for businesses and then goes there. Are you familiar with Cody Sanchez?
I am. We affectionately call her our top of the funnel, because she's the one that introduces most of our customers to the idea of buying a business. And then, as they really start to learn more and more, they get more attracted to us, because we are digging deeper and we are giving a little bit more of the full story. But I think without her introducing the topic, these people probably never would come to us.
Yeah, and that's the thing for me. And I feel based in the UK, there's a bit of a gap where we are. And I will, as I mentioned, I've spoken to a few friends. I've got a few friends who bought businesses on Flipper, and one who's very interested in buying and selling businesses. But he just says to me, I don't know where to go. I don't know who to look for in the UK. And I think a lot of people that they experience analysis paralysis, where they hear US based content, which is very specific, and then they can't transfer that, and they're trying to take a few principles. So, there's a few people out there, as you said, influencers who do the job for the masses, Alex Hormozy and entrepreneurship, and then people can retarget based off of him and similar interests. So it sounds as though the formula is working pretty well there.
It is. And yeah, in the UK, it's, a lot of the US content doesn't work, because what makes things work here is our SBA program. And essentially the government is going to subsidize your leverage buyout of a small business, which, so a lot of our content is going to be about, how to actually get those loans and how to utilize that. Because if you can't get the $3-4 million to buy the business, right, you're not going to be able to buy the business. So going through the methods to get the $3-4 million to buy the business, it's going to be really different in the UK. And I don't even know if there is something similar there.
Can you expand upon that concept, because I'm not familiar to it?
So in the United States, we have what's called the Small Business Administration. And one of the things that they do is they offer government-backed loans through banks. So you get the loan through the bank, but the SBA, the Treasury Department, is going to backstop 75% of the losses for the bank. So that means the bank's going to be willing to do a loan that they wouldn't do otherwise, because they have that government backstop, if there are any losses. And so what that does is there's these group of loans that you're going to be able to get. One, they're much easier just to get than a conventional loan, than a non-SBA backed loan. You get a longer time period to pay it back. You get 10 years for a business, 25 for real estate. And then you get, lower interest rates than you would without that government subsidy. So essentially the government is helping fund your purchase. And those loans go up to $5 million. And there's talk right now, they're passing a bill to potentially raise it to 10 million if you're buying in the manufacturing sector. So in America, everyone essentially, the government's giving everyone a $5 million check to go buy a business if they want to. And a lot of what we do is help people spend that money that they've already effectively been allocated by the government.
I didn't know any of this before. So you've opened my eyes and blown my mind, so to speak. What's the criteria for a person to go out and do this? Because naturally, the government is not going to risk, if you're taking out a $5 million loan, $3.75 million, and then the bank's going to take 1.25 on their shoulders. What does someone need to do? Do they need a track record of performance? Do they need a credit score? Do they need X amount of debt written off, or what does that look like?
Yep. So there's two sets of rules effectively. So there's the SBA guidelines. So those are hard rules. Everyone has to follow it. And they're really pretty low hurdle. So they would like to see a credit score of 680 or better. It can be lower if other aspects of the deal could make up for it. But 680 is generally the target. They're going to look at the business's ability to pay the loan. So, we've worked with people that were currently unemployed. They'd gotten laid off from a job, said, I, never want to go work for someone else again. So they had no current income. They're going to underwrite it completely on the business's ability to underwrite the loan. Can't have ever defaulted on a government-backed loan. So we have, a few other programs, student loans, FHA does housing loans, SBA loan. If you've defaulted on a loan to the government, you can't get any more government loans. So they'll look at that. You can have a bankruptcy. A lot of times they'll forgive one bankruptcy. If you have two, it's probably a no, but you can even have one. And then they are going to look for at least what they would call transferable skills. But then that's going to come up to the other set of rules. So then the banks each set their own rules. So their rules can be more strict than the government's, but they can't be less strict. So, for example, the SBA specifically says you're not supposed to use the amount of collateral someone has. So effectively, you can buy a $5 million business that has no assets. You live in an apartment, you lease a car, you have no assets yourself. You can still go and buy a $5 million business, but you might run into a bank that says, we're only going to do a loan if someone has enough collateral to collateralize the loan. And that's the art of finding the right bank. So there's some banks that will have no collateral requirement. There's some banks that have really high collateral requirements. And then also how they define, like basically how the resume fits the business is going to come up to some subjectivity of the bank. So each underwriter and each bank's going to look at that a little differently. So it's a very achievable hurdle. Most people probably qualify to buy something. It's, trying to find the thing that fits their resume the best. And then even people that don't, you could probably put them on a track to get them where they could within a few years.
Fascinating. And typically, what would the interest rates look like? Because I imagine the government charges 1% interest, the banks charge 1.5 on top.
So it's typically a floating rate. So for the most part, it's called the US prime rate. Then they'll add, the max that most banks will add on an acquisition is 3%. So, if the prime rate is at 6%, then, you're going to have a 9% loan.
Mm-hmm.
Today we're at 10 and a quarter, but as what would probably be the max. But that comes down, it's directly tied to the Fed funds rate. So when people hear the Fed raising or lowering rates, that directly goes into the SBA loan rate. You can get a fixed rate loan, which is usually, around like 8%, 7-8%. But at that, those are much harder to get. The underwriting standards are much higher for those loans. Typically have to make a big down payment. And, probably too much in the weeds. The variable loans, the banks typically sell off into the market, and there's a market where those bonds are traded. The fixed rate, they keep them on their balance sheet. So a bank's going to be much more strict about the underwriting on a loan that they're going to keep versus one that they're going to sell off.
Yeah, of course. Of course. In the UK, I just searched it now. It was abolished last year. It was called the LIBOR rate, London Interbank Offered Rate, and now they've replaced it to the ARR rate, which stands for Alternative Reference Rates, which I imagine are very, very similar. And banks just put their margin on top, and that's it. So if someone was a riskier candidate, would it be a case of the interest rates are higher?
Generally, no. So for the most part, everyone gets the same rate, and I think that comes through the subsidy. So if you have an 800 credit score and a 680 credit score, you're going to get the same rate. Where you can get a lower rate is basically putting bigger down payments and having more collateral. So if the banks can do a fully collateralized loan, so even if you default, they can go and sell the collateral and get it all back, then you can get a lower rate because that's a lower risk loan. So it's more based, the rate on the loan and getting a lower rate is more based on how much collateral you have versus like your credit score or kind of other aspects of the deal.
And just coming to think of it, do you think there's any economic risk whereby something like the Big Short happens again, the 2008 credit crunch? Could it happen with this type of scheme?
It could, and that's where we really, with the new administration, they've tightened up some rules. I think some of the tightening's been good, and I think some of it's been bad. But in the prior administration, they really loosened up the program, and they really made it a lot easier to access loans. And so that coincided with a lot of people, Cody, going much more viral during that period. So you've got a lot more people that maybe shouldn't be buying businesses, and then you had weaker, easier to access credit. So that has tightened up a little bit. So they raised the down payment requirements. There's a way to structure it. So today you can do it with as little as 5% down. Under the prior administration, you could do it with 2.5. So they had, and it was 5 before. So it was 5. They lowered it to 2.5, and now it's 5 again. So like that's one tightening up. They did change a rule recently to tighten up. A lot of industries require licenses. So like HVAC or plumbing, not everyone can just be a plumber. You have to go through training. Before there were ways around the licensing requirement. If you wanted to buy a business, you could to get someone else to hold it. And now that got shut down pretty recently. So like, I think that'll be a pretty positive change and preventing people from buying in industries that they really shouldn't. So there is a risk, right, that you could just make credit so easy that just anyone can come in and buy anything, and then they're just going to default on it. But they have tightened up on it, so at least where we're heading now, the underwriting's pretty strong.
Sure, makes sense. I'm going to be fascinating. There's a lot of research that I want to do after this podcast, just looking into it a bit more, and maybe looking
And I
at
really think,
what schemes are in the UK.
yeah, I mean, other countries really need to adopt it. I mean, that's really why the US has had so much success. Is I think the SBA program is one of the big reasons. And when I talk to people in other countries that don't have a similar program, there just really isn't as good of a path to start new businesses. And that's where job growth comes from, and that's where innovation comes from. And so without that SBA program kind of jump starting things, I don't think we would have had the strong growth versus the rest of the world, that we've had over the last 20 or 30 years.
Yeah, I mean, it epitomizes the American dream from my perspective. And looking at it, it looks as though a real starting block for a lot of people, as you were saying, that, and this is just a disconnect that I see between the UK, US. The UK, we're so, and I hope I don't fall into this category, that's not what I aim for. We're so risk adverse where everything is, but this could go wrong and this is a potential problem. And of course, within business, you always need to look at potential threats, weaknesses, externalities that might happen. But is it a case of stopping you from doing what you're doing? Whereas our best partnerships typically are clients, brands based in the US, and just the appetite for risk is so much bigger. Maybe it comes down to that being one of the factors there. So
Yeah. And the program pays for itself too. So it's not a taxpayer funded program. So there's guarantee fees when you take out the loan. And those guarantee fees cover losses throughout the portfolio. So, I mean, that's all the more reason for more countries to really just go and grab the exact model and copy it, is that it's not a taxpayer funded program. Of course, if it got in trouble, I think the taxpayers would be on the hook to jump in and save it. But historically, ever since the Bush administration put those fees in, it's been self-funding.
And with that, do you know roughly what the default rate is on the overall fund? How many businesses out of 100 typically default every year?
So I do think the official statistics might be a little understated. And it varies by year. It's usually between 1% and 3%. And I do think that's understated in some ways because the banks will work with you if you get in trouble, and the SBA will work with you if you get in trouble. So that doesn't mean that 97% of the businesses are thriving and doing well. It just means there's usually some type of work out done or some type of settlement and compromise done.
Yeah, it's
So
a zero-sum game
we've had
fundamentally.
they'll work with you if you get in trouble. So like if you just don't make payments, like they're going to come and take the collateral and shut the business down. But if you work with the bank and let them know you have problems, usually they'll suspend your payments for 6 months. If you still can't make your payments, then they'll kind of modify the loan to make something that you can service. I typically don't want people coming into it thinking that's something that's going to happen. You got to come in eyes wide open. If you put your family home as collateral on the loan and you can't make the payments, you should have the expectation that they're going to come and foreclose on the house. But a lot of the times they do work with you. If you work with them, they'll work with you. So I think the default rates are maybe a little understated versus kind of how the actual businesses are performing. But the official data is very low. And it does vary by loan size, which is interesting. Small loans default at a much higher rate than big ones. And I think some of that's typically bigger businesses are less risky in some ways. You have more customers, you have more infrastructure, small customer concentrations, they might be a startup. And then there probably is an aspect of, if you have a big loan, you control the bank. If you have a small loan, the bank controls you. The bank doesn't want a default of a $5 million loan. So they might be a little more likely to work with you if you have a $5 million loan than if you have a $50,000.
Actually, just detouring the conversation away slightly, but keeping to the integrity of own actions. Do you guys have a North Star where you'd like to get the business to?
So we're still adjusting. So, I think our original thought was, I wanted to try to take, 100 people from, 0 to $10 million net worth. Realizing that that's probably not realistic. And, we had kind of a 10-year time frame, and that not everyone wants to get there. We're pulling it back a little bit and focusing more on taking a smaller group of companies maybe further, and trying to work with the right people. So, our North Star, I feel like, is still a moving target because we effectively made up the way that we do business. So there isn't anyone that I can look at and copy. We made up our business model. No one else does it the way that we do. So we're making it up as we go. But we are moving away a little bit from that like volume to, who can be really great, and making sure we're partnering with people that can be, really great and take things really far, and focusing on that, and then focusing on what we can do to help them get there. So obviously the financial management, we help on the marketing, sales. We do have someone on our team that goes and helps with process management. If we can implement some AI, if we can automate some processes, again, anything that keeps them focused on what we think is customers and employees, will grow the business. And then we can also handle things like growth through acquisitions. So, being an M&A firm, that's a big path for growth for our companies as well, is buying more companies like them.
Yeah, I'm with you. There's a lot of interesting moving parts. And you touched upon something that we appreciate, which is artificial intelligence. Just detail to me, what does that look like? Yeah, because it's a moving piece. It's something that's come in over the last 3 years, taken the world by storm, arguably the biggest technological disruption that's ever happened, coinciding with the internet. But how are you best guiding, strategizing, helping your clients with that? And how are you implementing that in your own growth strategy?
So, we're always trying different things. And I'll say we still struggle with a lot of the AI, and that a lot of our areas, especially if it's interacting with customers, the tolerance for error is near zero. So, we've done a lot more testing than we've done full implementations,
Client zero.
just because it just makes too many mistakes. And most of our businesses are dealing with bigger ticket sales. So if it fumbles one sale, it's lost all of its value. But we've tried things like, services, AI phone answering service. That's obviously an easy one. In some businesses, it's worked better than others. In a lot of ways, it's just a glorified answering machine. Uh, and that's what it's good at. When you try to get it to really answer questions, it just seems to, at least our experience is that it doesn't give the answers we'd want it to give. So maybe there's too much of a control freak side but we want to make sure that what we say is accurate at all times, and it doesn't always say the accurate thing. And that could just be we're not good enough with it. But still, by playing with it and trying it out, like, it will be there. Like 12 months from now, I think our experience with it's going to be much different than it was today. So each test we run, it's keeping that in mind, that just because it didn't work today doesn't mean we shouldn't revisit it in 6 to 9 months. But we'll do things like one of the processes we're working on right now is we still have a company that they do a lot of their processes on pen and paper. The people on the ground, their desire to change their process just isn't there. And this company, they deliver water to drilling sites. So they take in clean water to a drilling site, and then they take out dirty water. So they want to keep doing the paper process. But since we're doing the financial management, that creates all kinds of headaches on the back end. So we do have essentially just like an N8N built process where the invoice comes in, we look at the image, then it goes into the accounting system, the invoice gets created, it goes through the whole cycle. So like that's a process that has worked pretty well. And, it's probably saved us, 20 hours a week, and, something that took, a day to build.
Yeah, the exponential gains from AI build outs is exponential, which is the easiest word to summarize. Mark, it's been a pleasure
Yeah.
talking to you. Where can people find you and what's next for you?
Yeah. So our website, it's owneractions.com. Our TikTok is where most of our content goes, and just owner actions. Most videos go to YouTube, not everything. So if you're not a TikToker, YouTube's a good spot to go. And you can always find me on LinkedIn, Mark Fleming.
Mark, pleasure. Thank you.
Yeah, thank you.